Chairman, you forgot me.
Oh, yes.
There's always thank you. Good afternoon, everyone. There's always been a mysterious feel about the words GST and refunds, especially. To simplify about this and to talk to us about this, we have amidst us a very eminent chartered accountant and Advocate V. Raghuraman. May I request a chairman of Ernakulam branch of SARC of ICAI, CA Ranjit to welcome us. Over to you, Chairman.
Thank you, Deepa Varghese. Very good afternoon to all of you, and welcoming you wholeheartedly to this evening webinar on GST refunds under various situations. As all of us know, as a matter of fact, as to how complicated, like how Deepa said, the mystery that still continues under the refunds aspect in GST. Be it from the excess payment of taxes, the ITC extra paid, or the refund related to export of goods or services. All of it, unfortunately, it still continues to be carrying a lot of weight for us, all practitioners, under the compliance aspect when it comes to. And with regard to the filing of required forms and papers so as to avail the refunds, all of which carries a weight still. And that is how we were very clear that Raghuraman sir could be the most apt and absolute personality today to be addressing us, to give us more light and enlighten us, in fact, on this special concept and topic. As all of us know, Raghuraman sir doesn't need any kind of an introduction to our Ernakulam branch members. The kind of acceptance he has with our members in Ernakulam, the kind of down-to-earth personality he is, we are truly happy and privileged to be welcoming a personality like Raghuraman sir. Wholeheartedly welcoming Raghuraman sir for the session today, sir.
Thank you, sir. Thank you.
When it comes to GST concepts or topics, or for any kind of seminars, what do I say? The advice that I seek from senior members like Lucas Joseph sir, Raman sir has truly been instrumental for me in helping organize all of this together. So I also thank at the outset the senior members who has helped me in this aspect, and I also wholeheartedly welcome them. We've got around 120 plus registrations for the today's topic alone. It's a 2-day webinar series, as you might know. Tomorrow, Advocate J.K. Mittal sir from Delhi is also addressing us. I wholeheartedly welcome the participants for the session today. I am also joined by my eminent managing committee colleagues, Secretary Deepa Varghese, Vice Chairman Jose KV sir, past Chairman, immediate past Chairman Roy Varghese sir, past Chairman Srinivasan sir. Wholeheartedly welcoming managing committee colleagues as well to the program today. Let us have a great time of learning, like I usually say, 3 to 6. Raghuraman sir, if we could, if at all you would like to have a 5 minutes break in between, we'll leave it to you, sir. So pretty much it. Let's have a great evening of learning today. Thank you so much. Back to you, Deepa. Something wrong with her net? Deepa, is there? Nonetheless, I'll quickly go into an
issue with her connection.
With her connection, no problem. Sir, I'll quickly go into the brief profile of Raghuraman sir. As all of us know, a chartered accountant turned lawyer. He is also a company secretary, CWA, CMA graduate as well.
I'm sorry, there were some connection issues.
No problem. I was just going through announcing the profile of.
It's my pleasure actually to introduce Raghuraman sir, because I heard about the word GST first from him when I attended the certification course way back. And to introduce Raghuraman sir, he is a BCom graduate, an FCA, ACS, LLB, and a graduate CWA. He's achieved so many ranks: first rank in BCom, 38th rank in CA Inter, 24th rank in CA Final, second rank in CA in ICAI Inter, and 25th rank in ICAI Final. Wow. And that's a 30 years of chartered accountancy and advocate profession for him. He's been practicing mainly in indirect taxation and is also a visiting faculty at IIM Bangalore. He's addressed large number of seminars and published several papers, and has been an author to 2 books, Landmark International VAT Decisions and Its Relevance to Indian GST. It's been published by the international publishing house Walters, and GST and Indirect Taxes Principles Demystified, which has been published by International Publishing House, CCH. Sir, we are all anxiously waiting to hear from you more about GST and refunds. Over to you, sir.
Thank you, madam. Thank you, Ernakulam branch. It's been a pleasure for me to always address the Ernakulam branch. We have some wonderful people in Ernakulam branch. I miss coming physically there because that would give me an opportunity to go to Guruvayur and have darshan also. But nevertheless, this platform which we have now got used to over the last 1.5 years seems to serve the purpose very well. Only thing it saves a lot of time in travel, and the hotel bills will be less for ICAI, and of course the camaraderie that goes along with meeting somebody physically is missing. There's no doubt about that. Now, when this topic was in fact suggested by the chairman of Ernakulam branch, I was very happy because I have addressed on refunds only a few times, mostly constitutional issues, concept of supply, those kind of things have addressed a lot. This refunds is something which is of a lot of importance to people. We fight a lot of cases on refunds, but hardly the amount of seminars that we have done on refunds is relatively less. So I thought this is a good opportunity for me to revise GST once more. Can't say that you are an expert or something, because many times we miss a few things even while taking seminars. So it's a good time to revise the GST and the refund. So what I thought is, rather than restrict it only to this GST, I'll also touch upon certain other topics which will be of interest, because that gives incentive to exporters. So we have to look at export incentives also as an important, policy measure, which will be of good practice areas for chartered accountants in the future. We can't restrict it only to GST. So I'll just touch upon those issues also. The first thing which, of course, I will touch upon in refunds is this. The question which arises is on exports, especially. Can you have a restriction on export refunds? Can you have formulas laid out for export refunds? Can you have rules laid out for export refunds which restrict the refund? Or let me put it this way, can you have any regulation for exports at all in the CGST or IGST Act? That is the question which arises first, which we have to answer. Because if you look at the GST legislation which has been made, one is intrastate supplies, that is within the state, if there is a supply, you have a CGST Act, you have a SGST Act. The source of the power goes back to 246A of the Constitution. Now, when you talk of interstate sales, that is between two states, the source of the power goes back to 246A2 and 269A. Now, if you look at 269A, you will surprisingly find that the union legislature can legislate on interstate sales, interstate supply. What they say, supply in the course of interstate trade or commerce. This is the terminology which is used. And a proviso is fixed to 269A1, which says, for the purpose of this clause, supply in the course of import will also be considered as supply in the course of interstate trade or commerce. So as to say, import transactions are also treated as interstate transactions. And only the union legislature can is competent to levy this tax through a legislation. The states have no role to play in this. Now, there is no deeming fiction, nor is there any reference to exports. Neither in 246A nor in 269A, there is any reference to exports. For the last 2 years, I have been telling that export transactions are not amenable to the GST legislations as yet. The reason being, consumption is outside of India. GST being a consumption tax, it is not possible for you to bring about a consumption tax on something where the consumption itself takes place outside India. So therefore, there is no reference to exports in the constitution at all. And if that be so, will it be appropriate for the legislations which draw their existence from the constitutional provisions? Can they have any reference to exports is the question. I'm aware that the Bombay High Court has, there are in the case relating to intermediaries, has taken a split verdict. One is 1-1, 2 judges differing, and it's referred to third bench. But that is on intermediaries. It's not on. But the concept is this: can you regulate exports? It's a larger question where I have filed some writ petitions in Karnataka High Court. It's yet to come up for a final hearing. Fact of the matter is that we will discuss this in the rest of the session, assuming it is constitutional. It's another thing that you may say that it is unconstitutional, but for the purpose of this session, we will assume that it is constitutional and then proceed and see what are the provisions relating to refund. Because when you talk of refund, it is not only on exports. The refund can relate to so many other things. Those provisions will be constitutional. It's only the export transaction provisions where we may think that it is not, constitutional, because exports cannot be regulated by the GST or IGST acts, neither Section 16 nor Section 54 as regards exports can place any restriction, in my humble opinion, because the Constitution itself does not talk of any restriction on exports. That being the case, now let us look at the several instances where this come about. Now, refund of tax, if you look at the provisions there, you have to read Section 16 of IGST, Section 54 of CGST, and the related state legislations. Rules 89 to 97, Section 55, 56, 57, Section 77 of the CGST Act. So these will be the relevant sections and rules. Now, if you look at Section 15, this also covers refund when the tourist leaves India. That is 15 of the IGST. 16 of the IGST is zero-rated supplies. And Section 19 relates to refunds in certain circumstances. These are all the legal provisions relating to refund. Mainly, we will concentrate on Section 54 and then go into the rules and other provisions of the law. Now, Section 54, what do you mean by refunds? What is covered in refund? If you look at the scope, 54.1 is the master section. 54.1 is the master. Any person claiming any refund of, that is how it opens. Any person. Please understand, Section 54 section doesn't apply only to suppliers, it applies to all persons, including the consumer. That is why it opens with the provision, any person claiming refund of any tax or interest or any other amount. Tax, interest or any other amount. You may want a refund of penalty, you may want a refund of fee, you may want a refund of cess or whatever it is. Any other amount. Everything is covered in the scope of refund. 54(1). Tax, interest, penalty, fee, etc., etc., etc. Any amount. Please understand, when they say any other amount, it's not only taxes, it could be even many other amount. Now that is the discussion which we will keep further. We'll park it aside. We'll discuss it separately. Because there is some amount of controversy on whether Section 54 applies only to taxes or any amount which is not in the nature of tax. So we'll come to that a little later. Now, if you look at explanation 1 to Section 54, please understand all these provisions are borrowed largely from Section 11B of the Central Excise Act and Section 27 of the Customs Act. Now, refund by definition has 3 categories. I want all of you to remember these 3 categories because it is of some importance when we discuss further. Tax paid on the end supply. That is the goods or services which I supply when I pay tax. That tax can be refunded. That is one. Inputs or input services which are used in making such supplies called zero-rated supplies. That also can be refunded. Zero-rated supplies itself means 2 categories. When I say something is zero rated, there is a difference between zero rating and exemption. Exemption means the end product need not suffer any taxes. But on the input side, it may suffer taxes. When you say zero rated, it means by definition in the IGST Act, Section 16 says zero rated are 2 categories. Export of goods or services, supplies to SCZ units or developers. These are the 2 zero rated. Zero rating means all taxes suffered on the goods and services, whether on input side or output side, will be reimbursed. That is why refund under Section 54, the first category is zero rated goods or services, both on the input and output side, there will be a refund if you have paid the taxes. 1. Second category of refund, deemed export refunds. There are certain categories of supplies which don't leave the country, which may not earn foreign exchange, but they save foreign exchange as per the foreign trade policy. These categories are called deemed exports. You have, for example, supplies against advance licenses, supplies to EOUs. These are called deemed exports. Why are they called deemed exports? Now, an EOU can import goods without payment of any taxes. They can import from USA, they can import from Australia, anywhere where they want. Instead of importing those goods, if they take those goods from an Indian customer, in other words, they take a local goods as a substitute for the imported goods. As far as the local manufacturer is concerned, it becomes a deemed export for him because he's saving foreign exchange for the country. Otherwise, the EOU would have imported and spent foreign exchange. For that reason, it is called a deemed export. Similarly, supplies against advance licenses or EPCG schemes come under this category. So this is the second category. First category is the zero rated, that is exports and SCZ supplies, where refund is given of end product or end supply taxes and input tax. Second category is deemed exports. Third category is refund of unutilized input tax credit. So these 3 categories are very important. The third is a refund of unutilized input tax credit. That is, if I am not able to take a refund on exports because of whatever formula I use. I'm not able to utilize it also in domestic. In such cases, it becomes unutilized input tax credit. That can also be taken as a claim. Unfortunately, I find in many of our discussions and seminars, this categorization is not being done because the time limits for each of them may be different. So you have to be careful with all these three categories. Now let us look at the first and most important, which is zero-rated supplies. When I mean zero-rated supplies, refund of taxes on some exports of goods or services, or supplies to SEZ units, supplies to SEZ developer. When I say export of goods, export means by definition under the IGST Act 2(5), taking goods out of India to a place outside India. Please understand, this is a very specific definition borrowed from the Customs Act. Taking goods out of India to a place outside India, because in the earlier, before these definitions came into the Customs Act, there were controversies. A ship was, let export order was passed. Let export order passed. Ship has not left India. Goods, let us say, get destroyed. Question which arose and this all went up to the Supreme Court is whether drawback can be given on this, because let export order has been given. It was held that drawback is available in respect of such goods, even though they have not left India. So in customs legislation, if you see drawback rules and then the Customs Act, they changed the definitions to say that it should go out of India. That is why you say taking goods out of India to a place outside India first. Secondly, drawback rules were amended to say you should realize foreign exchange, then only you are eligible for drawback. Obviously, if the goods are lost or destroyed, even though let export order is given, the foreign supplier is not going to pay you, and therefore drawback will not be available. So this is how they plugged the loopholes in the customs legislation, and therefore the same thing has been incorporated in the IGST Act. But when you look at services, you must understand this. Export of goods, you have to take the goods outside India. There is no condition on realization of foreign exchange. The condition is not there. Those conditions, if you see later, have been incorporated in the rules, and to that extent we will study whether the rules are ultra vires or not. We will come to that discussion later. Export of services, what do you mean by export of services? 2(6) says export of service means you have to satisfy the following conditions. Supplier of services should be located in India. Recipient of services should be outside India. Place of supply should be outside India. Payment should be in convertible foreign exchange or Indian rupees if authorized by the RBI. And the supplier and recipient should not be branch office, that kind of relationship. They should be independent parties. If these conditions are satisfied, it becomes an export of services. The question which I will answer here itself is, kindly understand, if you do not satisfy any one of these conditions, it will not be called the export of services. But if the service is consumed outside India, it cannot be taxed. Please keep this in mind. If you don't satisfy the export of services definition, at the most you will lose certain incentives. You may not get input tax credit refund, or the integrated tax which you pay on exports, you may not get the refund. But please understand, you cannot be taxed on the transaction. If the government says you're not exported, you can still get a refund if it's consumed outside India. That is my humble view over here. We will look at what is the time limits for claiming the refund in each of the cases. What type of refunds are available? Broadly, we'll look at what types of refunds are available under 54 and what is the time limit broadly left for each of this. At least 2-3 instances we will take and see. The general provision for refund is that tax, interest or any amount under 54(1) refunds can be got within a period of 2 years from the relevant date. Now, relevant date is defined in section 54. We will come to what is relevant date later on. Broad scheme I'm telling you. If you are an exporter, the broad scheme is that within 2 years of exports, you can claim the refund. 2 years of the relevant date, you can claim the refund. That is the first thing you should remember. Under the excise regimes, it was all 1 year. Now in the GST regime, it has been made into 2 years. Now, if you're claiming any refund of balances in the electronic cash ledger, which falls under section 49(6), you can claim it in the refund in the GSTR 3B itself. There is no need for you to give any separate refund claim. Straight away, you can claim it in the GSTR 3B and it will be refunded in accordance with Rule 89. So the matter ends as far as balances in electronic cash ledger are concerned. Supposing you supply goods or services to UN or multilateral financial institutions, consulates, embassies, foreign embassies. Here you must understand, the refund is not available to you. It is available to the embassy. So you will have to pay the taxes, whether it is services or goods. And the recipient will have to file a refund claim within 6 months, within now it is 18 months of the quarter in which the supplies have been made or received. So please understand, any supplies to embassies, consulates, UN organizations, tax has to be paid by you. Refund will be granted to those people, not to you. The recipient gets the refund. I told you there are 3 categories of refunds in 54. One is especially for exports. One is exports of goods or services or supplied to SEZ, zero rated supplies. 2, deemed export. 3, unutilized input tax credit. Now please understand, unutilized input tax credit, what does it mean? First, we have to exhaust this. The quarterly claims that you do under 89(4), Rule 89(4), is the regular input tax credit refunds that you are eligible to get. For the quarter, whatever credit is got, you take back that amount as a refund under 89(4) on exports. But please understand, that is not unutilized input tax credit. That is the credit which you have taken during a quarter. Unutilized input tax credit means after taking the credit, you're not able to utilize, then you claim for refund. Partially, it will be covered under 89(4). But strictly speaking, unutilized input tax credit means that when goods are exported under bond or LUT without payment of any tax, when services are rendered without payment of tax by executing bond and LUT, you have credit getting accumulated on the input side because you don't pay taxes on the output side. This credit which accumulates on the input side, you can utilize it for domestic transactions. So if you have a domestic, if you have domestic supplies, you can utilize. But supposing you don't have domestic supplies, or domestic supplies is very minuscule. In such cases, the input tax credit gets unutilized. It's not utilized fully, or it's not utilized at all. In such cases, 54.3 will come into play. And 54.3 refunds are of unutilized input tax credit, and it is given in only two instances. One, zero-rated supplies will get the refund, that is exports of goods or services outside India, and supplies to SEZ unit or developer. Category 1. Category 2, inverted duty structure. The inverted duty structure means that the rate on inputs is more than rate on output, because of which credit accumulates. Inverted duty structure refunds are given. Now, if you see the time limit for claiming a refund, very strangely, this is something which Ernakulam members, especially Mr. Raman Kuti and our Mr. Soman, if he is there, will have to take note of. The relevant date for filing a refund claim is defined in respect of inverted tax structure. Earlier, it was at the end of the financial year. Now it relates to a return. When I file a return, within 2 years from that date, I can file the refund claim for inverted duty structures. But when it comes to unutilized input tax credit, I find from the provisions that there is no reference to any time limit. Time limit for regular input tax credit refund is there. That is what you take in the quarter. That is there. 89.4, that is there. Inverted duty structure, time limit has been prescribed. Relevant date is prescribed as when you file the return. 2 years from that date. But for unutilized input tax credit, strangely, I am not able to find any provision which says you should file this refund claim within 2 years of what date? No date is prescribed. So therefore, it looks to me that if it is an unutilized input tax credit, you are free to file the refund claim at any time. If you have missed filing the refund claim, there is nothing wrong in you preferring it even now. Now, refund scenarios can arise in several, instances. I have tried to list this under 12 instances. Exports outside India, supplies to SEZ and developers, deemed export, unutilized input tax credit refund, an inverted duty structure, refunds which can arise because of favorable orders from the judiciary, refund of taxes paid to the United Nations or embassies, etc., refund arising out of provisional assessment finalization, refund of pre-deposits made for pursuing an appeal, genuine refunds arising because I've made payment by mistake. And then you have refund provisions where persons who are embarking outside India, tourists, buy some goods from the duty-free shops and take it outside India. Those refunds are also possible. There is refund which can arise where you have issued an invoice and then a refund voucher. Or you have got an advance amount which you have not rendered services, you have to return the amount back. Then you have a refund where you pay taxes intrastate, but it is tomorrow told it is interstate. And these kind of transactions. So around 12 categories come under the refund. Apart from this, you have incentives outside of the GST Act, advance license scheme under the foreign trade policy, export promotion capital goods scheme under the foreign trade policy, and certain new schemes which have been announced by the government, which I will deal with at the end of the session, which are meant for refund of taxes embedded in exports. So many avenues are available. So what I will do first is I will do the most important refund provisions first and leave the rest for further discussions. The first and foremost I will be dealing with is where exports take place outside the country. Now, always the government has messed around with this. When exports takes place outside the country, Section 16 of the IGST Act always would say this. You pay the tax, claim a refund. Or you don't pay the tax, claim the input tax credit refunds. Two options were given always in Section 16. When it came to the rules started restricting all of them, leading to any number of litigation that has taken place before the high courts in the country. Madras High Court, Gujarat High Court, Karnataka, every state, Bombay, Delhi, everywhere. 2021 amendments which they have brought about but which are not notified as yet tries to straitjacket this under the amended Section 16 of the IGST Act, or they proposed to amend it to say refund of integrated taxes will be only where they notify. This is the intention of the government. Default will be export without taxes. Export under bond LUT is the default. If you want refund of integrated taxes, they are going to announce the products, class of products for it, or class of exports only for those kind of transactions. So prior to 2021 amendments, it is very clear that Section 16 gave a clear option to all the exporters. You can either go under bond LUT, or you can pay the integrated tax and claim a refund. Either of the routes are available to exporters. Now, with this in mind, let us study what are the options which are available. What are the provisions that are available? What are the relevant dates for these exports? Now, when you talk of export of goods or services, it means I am taking the goods out of India to a place outside India. As far as goods, services, whatever conditions I told you. So when should I prefer this refund? When it comes to export of goods, the relevant date is when the goods leave India. If it is that is by sea or air. If it is by export by land, when it crosses the Indian frontier. And post when it leaves India again. So normally in export of goods, when the goods are loaded and it leaves India, it becomes export. From that date, 2 years time you have. Export of services, however, there has been a lot of litigation in the service tax regime, but now what is relevant for us to note is the relevant date for export of services will be either issue of invoice or receipt of payment, whichever is later. If I receive payment first, whenever I complete the services, that date will be the date of export. So from that date, 2 years time you have. Supposing I've issued the invoice today, but I get the payment later. Then in such cases, the payment will be taken, and from that date, 2 years is available. So you have generally 2 years from invoice date or from the service date or from payment, whichever comes at the latest point of time. Sufficient time is given to people, in my opinion. And the refund scenarios are two. Please understand. What we're discussing is export outside India, not SEZ supplies, export outside India. When you export goods outside India, you are given the option of payment of taxes under Rule 96. You pay the integrated tax and claim the refund. Now, you may well ask me, why will you have to pay the refund and then pay the tax and then claim refund when you can execute a LUT bond and be done with it? Why can't you simply do this? Yes. Where it's an option given to you, where you can cash out the refunds. You can go under either of the options. Pay the integrated tax, take out the refund so that your balance in the input tax ledger comes down naturally. Or under the LUT scenario, you can simply claim all the amounts that are there. The only thing is the formula works in such a way, it calculates the tax paid or input tax paid only every quarter. What happens to the accumulated balances? So if your integrated tax is much more than the input tax credit which is available, it is better for you to pay the integrated tax, debit the credit ledger, completely take out the amounts as refund, so that over a period of time, all your accumulated balances will start getting cashed out. That is why people pay tax and then claim a refund. Now in 96, and please understand this is available only for exports outside India, not for SEZ supplies. So Rule 96 applies only for export of goods or services outside India. It's a very simple and easy procedure. Procedurally, you file a shipping bill in the customs. And once you file the shipping bill in the customs, that is deemed to be a refund claim. So you have a 2-year period to claim as per the law under Section 54. Rule 96 makes it much easier for you, because when you file the shipping bill itself becomes a refund claim. It will be matched with your GSTR 1, GSTR 3B, especially your table 6A, which comes there if the dates are extended. It will be matched with that. And once they match the shipping bills with the invoices in your GSTR 1 or 3B, as the case may be, immediately the report for exports is generated, and the refund will be credited directly into the bank account which has been given. This on paper is a beautifully simple procedure to follow. Refund can be held up only in certain cases. Rule 96 says if the jurisdictional commissioner puts a hold on it, or you have violated the provisions of the Customs Act, only then will the refund be held up. Otherwise, this refund goes on smoothly. Similarly also, but in services, it is a little different. In goods, if you see the shipping bill is filed, the shipping bill becomes a application for refund itself. But as far as services are concerned, you have to file a separate refund claim under RFD1, which is to be followed. That has to be done within 2 years of either, I told you, invoice or payment or services. This is the broad procedure under 96 for claiming the refund. But 96 has run into a lot of rough weather, a lot of interpretational issues, a lot of litigation. Why? What the department did was this. They introduced 96 subclass 10. The purpose of introducing subclass 10 was that if you have availed any benefit under the advanced license scheme, if you have availed any benefit under the EPCG scheme, of course, then they amended this to get rid of this EPCG restriction. Merchant exporters supplies. If you are receiving this, if any imports are being done under the advance authorization scheme, what they try to say is integrated tax 96 will not apply. You have to compulsorily go under 89. You can't come under 96. Therefore, unfortunately, this rule got challenged in the Gujarat High Court, and the Gujarat High Court, of course, upheld this rule 9610 because it was not argued properly. Matters review petition is pending against that judgment in Gujarat High Court. You see, this rule 9610 unfortunately goes against the very principle of refunds under section 16 of the IGST Act. IGST Act allows you an option. Either you pay the tax and file the claim a refund, or you don't pay the tax and claim refund on the input services or goods which you have already, the tax is already paid. Option is given to you. Now, 9610 puts a restriction that if you claim these benefits, you can't go under 96 at all. You have to go only under 89. That means compulsorily you have to export goods under bond. There's no question of payment of integrated taxes. Unfortunately, nobody has pointed out to the courts that when I import something under an advance license, I will not pay any tax. So there's no question of double benefit. There's no question of double benefit. When I import something under the advance license scheme, what am I doing? I am getting the goods without payment of any tax. If I don't pay tax, where's the question of taking input tax credit? I don't take. I will take input tax credit only on the other locally procured goods or in other imported goods on which I pay taxes. That being the case, the question of me claiming a double benefit doesn't arise. Neither the department has understood this, nor have our councils also argued this. So 9610 restriction is not necessary in my humble view because there is no question of claiming a double benefit. If I take input tax credit, then you can tell me, yes, you're claiming here, you're claiming there also. There's no such thing. This has not been pointed out in Cosmo Films case before the Gujarat High Court. And therefore, I feel, that these important aspects are completely missed out while arguing and have to be redone before the High Court. But all the matters relating to 9610 are pending across the country. So please understand, 96 is only for export of goods or services where I choose to pay integrated tax. The general procedure for exports is laid out in 96A. That is what I should do. Rule 89, read with 96. If I don't want to pay integrated tax at all, what is my procedure? That is, I'm exporting goods or I'm exporting services. My output tax from the goods says 18% or services is 18%. When I say payment of integrated tax and refund means I will pay that 18% and then claim it as a refund. The second option is, which most people follow, I don't pay the tax at all. Why claim, why pay the tax and claim a refund? I execute a bond or bank LUT, as they call it, letter of undertaking. I execute a bond or a letter of undertaking. Once I execute a bond or letter of undertaking, I don't pay tax on the end supply. I just take it out of the country without payment of taxes. On the input side, whatever tax I pay, I will claim it as a refund under 89. This is the procedure which is followed largely. So when I do these exports, and this is applicable even to SEZ units and SEZ developers, I will execute a bond or a letter of undertaking with the department saying that I am going to export these goods or supply to a CZ. Now, there are restrictive conditions in this 96A. What it says is this. If you do not export the goods, you say today I'm going to export the goods, take it out of your factory or whatever it is. I don't export the goods. 3 months have passed. 15 days of expiry of the 3 months. If you are not exported the goods, then 96A says we will enforce the bond and LUT. You will have to pay the tax and interest. Failing which, we will take recovery action under section 79. That is what rule 96A says. We will take recovery action under section 79. Now this rule has been challenged by me in the Telangana High Court, I think, where I have said that execution of bond and LUT itself is not required for exports under 269A or 246A, as I told you at the beginning of the session. Now, even assuming I execute the bond and LUT, you cannot force me to pay taxes by recovering it under section 79 without doing an assessment. There could be several reasons why I am not able to export. Give me a show cause notice. Adjudicate the matter, then you recover. You find that, okay, fine, I have taken the goods and diverted it for local consumption, let us say. Yes. Issue notice to me under 73 or 74. Hear me. The petition has been admitted in Telangana High Court. Because you have to be heard before you are condemned. Similarly, the same 96A says as far as exports are concerned, you should realize the foreign exchange or the Indian rupees if allowed by RBI. You have to realize it. If you do not realize that amount within 1 year of your export, then you have to pay back the tax, pay back with interest. If you don't do so, section 79 recovery will be done. Garnishee proceedings will be started. So that also I have challenged, saying that you cannot do this without issuing a notice. One of the unfortunate, issues in GST law is that at every nook and corner of the rules or even the act, we find if you don't comply, we will go for recovery. It is like threatening. It is like threatening. If you don't do this, I will do this. Like the third standard and second standard children fighting. The government is telling the exporters, poor fellows who are exporting. Government is telling them, if you don't do export, I will go do garnishing. The third standard person will tell, if you do anything, I'll tell you daddy. That way, no? I can't understand this. In fact, I believe that if you feel that the person has violated the conditions of the bond or LUT, then you should have a provision for taking action under 73 or 74. If you do not do that, in my humble view, enforcement of a bond or LUT cannot be done under the GST law. It has to be done only under a civil court. It is a contractual bond. If I don't pay the GST, the only thing you can do is to go to civil court and enforce the bond. How can you say I will recover the taxes without an assessment? So in my view, I think the provisions of 96A are unconstitutional, or at least ultra vires the act. Both. And since they do not even give a provision for complying with the principles of natural justice, There are two decisions, of course, in the income tax regime, CB Gautam's case and Sahara India firm's case, where the Supreme Court says if you have civil consequences which follow you, principles of natural justice will have to be followed. So in my view, 96A, I think, has to be struck down or read down to comply with this. Now we come to 96B. 96B is a very funny provision. It says, if I have given you a refund and subsequently the goods are not exported, the goods are not exported, but I have given you a refund. That is 96A. You have exported the goods, 96B, but you have not realized foreign exchange. 96A is a scenario where I execute LUT bond, I don't export. Or I don't export in time, 3 months time, or I don't realize foreign exchange in 1 year time for services. 96B is only for goods. It is not for services. 96B says, well, let us assume you have exported the goods, but you're not realized foreign exchange. What happens? Unless the proceeds are written off because of permission granted by the RBI, what the rule says is that you are given, say, 6 months or 1 year time to realize the foreign exchange. If you have not realized it within 30 days of non-realization last, you must pay the tax with interest. Subsequently, if you realize it, we will refund back the tax. We'll refund it back to you. So 96B applies to goods where realization does not take place. Now, the fundamental problem with 96B is simply this. Under 2(5) of the IGST Act, export of goods has nothing to do with realization and foreign exchange. If the goods are exported, they're taken out of India to a place outside India, it is termed export. There is no condition for realization like in export of services. So if you give me a condition under 96B which says that only if you realize I will, recognize it as export is wrong. Secondly, the refund which has already been granted to you cannot be recovered on the ground that there is no realization, because as far as exports are concerned, realization is not a condition under the IGST Act. So Rule 96B falls foul of Section 2(5) and Section 16 of the IGST Act. And therefore will have to be struck down again, I'm telling you this. So if you have any show cause notices issued to you trying to recover this tax amount which has already been refunded, kindly approach the High Court for striking down Rule 96B. It is not a good piece of legislation at all. Now let me come to SCZs. Now, as far as exporters are concerned, you've seen goods and services. I can get what kind of refunds? You've seen it. 89.4, 89.5, I will deal with it a little later. SCZ units, what are the refunds which are available? As I've told you, SCZ supplies to SCZ units or developers is treated as a zero-rated supply. But condition is this: even though it is zero-rated, 96 rule is not made applicable. Only 96A is made applicable for purpose of executing bond or LUT. That means to say, when I supply to the SEZ, it is compulsory for me not to levy a tax. I should not levy taxes. I have to compulsorily go under the LUT or bond procedure. This is what Rule 89 says. This is what Rule 96A, 96 say. That is, I will not be able to go under the rebate procedure or the refund of integrated taxes. I can go only under this bond procedure. Now, if you look at it, let us look at section 16 as it stood prior to the amendment. If you look at section 16, prior to the amendment, any zero rated supplies, you had the option. You had the option, either you can go under integrated tax or this. So making SEZ supplies compulsorily to comply only with the bond procedure and not the integrated tax refund procedure was completely wrong. In fact, there is a decision of the Gujarat High Court in the erstwhile excise rules, 18 and 19, we had the same problem. Rule 18 was rebate, which is akin to refund of integrated taxes, and Rule 19 was your bond procedure. There the same issue happened, where notifications were issued restricting exports only under bond. There the Gujarat High Court in Zenith Spinner's case struck down the notifications, saying you cannot impose conditions when the exporter has an option to go under 18 or 19. You can't say you should go only under 18, you should go only under 19. Not possible. Same way, in my opinion, SEZ supplies also should be eligible for payment of integrated taxes. Now, leaving that aside, what is the government saying? Government is saying if you export out of India, you have option. You pay the tax, claim a refund, or you don't pay the tax, claim the refund on the inputs or input services. But when it comes to supplies to SEZ, the government says no tax will be paid by you. You have to go under bond only or letter of undertaking. And whatever credit is available, input tax credit is available, claim a refund. Claim a refund. We will give you a refund under 89 bracket 4. Read with 89 bracket 1. But you should not charge any end product or end service tax to the SEZ unit or the developer. Condition for SEZ is it should be used their authorized operations. The invoices should be countersigned by the authorized officers. Based on that, you can claim for unutilized tax refund or even regular refund under 18N4 based on the turnover. This is the procedure as far as SEZ supplies are concerned and SEZ developers are concerned. And for them, as I told you, bond procedure is made compulsory. Now we have deemed export. What do you mean by deemed export? Which I told you briefly. Deemed exports are those which are notified under section 147 of the CGST Act. Notification 48/2017 lists out certain deemed exports. These are not all the categories of deemed exports, only some categories have been listed. Supply of goods to a person holding an advance authorization. Now, an advance authorization, let us assume A holds an advance authorization. If A holds an advance authorization, he can import certain goods duty-free. But instead of importing, he procures the same goods locally from B. As far as B is concerned, it becomes a deemed export because he is saving foreign exchange for the country. This is classified as a deemed export. Same applies to capital goods which are supplied under the EPCG scheme, which can be imported duty without payment of duty, but which is procured locally. It becomes a deemed export for the person who supplies. Similarly, a person who supplies to EOUs instead of export, that is also considered as deemed export. Even supply of gold against advance authorization by banks or public sector undertakings is considered as a deemed export. Now, in cases of deemed export, it is very clear. There's no confusion here. If the supplier pays taxes, the recipient can claim refund. The supplier wants to claim refund, the recipient should not take input tax credit. Very simple. So when I supply goods which are considered deemed exports, when I pay the taxes, the recipient can claim a refund. So matter ends. As far as the supplier is concerned, he pays the taxes. Recipient will have to prove it's a deemed export and he claims a refund. Now, if I want to claim the refund myself, then the recipient should not take input tax credit. So they have made the deemed export schemes very simple. If the recipient is claiming input tax credit, he will not get the refund, nor will I get the refund. Because he is claiming the input tax credit, the matter ends. But if input tax credit he is not claiming at all, then he can claim the refund or I can claim the refund. Simple. This is as far as deemed exports are concerned. It's a very simple scheme. Now we will look at inverted duty structures, that is accumulated credits. We have touched exports of goods services briefly, 89.4, 89.5 I will come to a little later. Please hold up with me. First we'll do 89.5, then we'll go to the other ones. Inverted duty structure 54.3 says this very clearly. If the rate on inputs, I will read out this because it is of some importance to all of us. Subject to the provisions of subsection 10, which is not relevant now for us, a registered person may claim a refund of any unutilized input tax credit at the end of any tax period, provided that no refund of unutilized input tax credit shall be allowed in cases other than zero-rated supplies, which we have already dealt with, without payment of tax. 2, that credit has accumulated on account of rate of tax on inputs being higher than rate of tax on output supplies, other than nil rated or exempted, and other supplies which are notified as not being eligible. Now, this has come for considerable amount of litigation. Now, what the inverted duty structure is, if the rate of tax on input is much higher than the rate of tax on outputs, obviously, it will lead to credit accumulation. And if it leads to credit accumulation, automatically, to the extent of the difference, I should be given a refund. Now, issue comes here, what is the quantum of refund? If you look at Rule 89 bracket 5, Rule 89 bracket 5 says quantum of refund will be restricted only to the extent of accumulation arising out of inputs, not input services or capital goods. Even though initially the rules covered both inputs and input services, they made amendments to the rules 89.5. They made amendments to 89.5 and said it will be restricted only to that extent of supplies, the tax accumulation arising out of inputs, not input services or capital goods. So obviously, the people who are having credit accumulating challenge this. They said, please understand, when I have an inverted duty structure, you have defined it as if the rate of tax on inputs is more than rate of tax on output. That is the only condition to be satisfied. If the rate is more and I'm having accumulated credit, the entire credit has to be refunded. Whatever is accumulated has to be refunded. Not just only to the extent where the accumulation arises out of inputs. So Gujarat High Court considered this in VKC Footsteps case. In that case, the person had claimed refund of input and input services accumulation. Capital goods he had not claimed. Input and input services. He said, my rate on input is more than the rate on output. There is accumulation happening not just because of input in input services. I should get the benefit of both the refunds. Gujarat High Court, reading the clause very clearly said, if you look at it carefully, provided that no refund of unutilized input tax credit shall be allowed in cases other than. When you say unutilized input tax credit by definition, if you go to 262 and 263, 2(62) and 2(63) of the CGST Act, it talks of tax credit on goods and services, both. Not restricted only to inputs, goods and services. Capital goods, inputs, input services. So the Gujarat High Court said, yes, you are entitled to both the components, refund, inputs as well as input services. The same issue was argued before the Madras High Court. The Madras High Court took a contrary review. They said, no. What the government has done is right. It should be restricted only to the extent of the inputs and not the input services or capital goods. So what formula the government has put in is quite in accordance with the law. This is what the Madras High Court. So both these decisions are now pending before the Supreme Court for a final decision. It would have been argued, but for the lockdown, I think it will take some time now. But the matters are now pending before the Supreme Court. Now let us look at 89(4), because that is what we have left out in these exports. Now, if you look at 89(4), what is this 89(4)? Refund of input tax credit. Refund of input tax credit on what? On zero-rated supplies. 89(5) is inverted duty structure. 89(4) is exports or supplies to SEZs. Here also, in 89(4), we are having a lot of issues. We will come one by one. 89(4) will apply to cases where I supply to SEZ units, SEZ developers, or I export out of India any goods or services by executing a bond or LUT. That means on the output side, I don't pay any taxes. And on the input side, whatever taxes I have paid, I claim as refund. The question which arises in 89(4), if you see the formula, is there are a lot of questions which arises. They will put in a formula like your 80 HHC formula. Even for the inverted tax duty structure, they have one such formula. Here they say turnover of export goods to total turnover multiplied by the input tax credit, proportionate refund is given to you. If your exports is 10 rupees, your local turnover is 5 rupees. 10 by 15 into the input tax credit, 2/3 of the refund you will get, or 3/4 of the, whatever it is ratio you will get. 2/3 of the refund you will get. Other 1/3 you have to use it for your domestic thing, because your turnover is only, export turnover is only 2/3 of your total turnover. So 2/3 of your input tax credit which you have, they will refund you. Here also, if you see, what do they say? There are several issues which come up here. Here, and this is where I will draw you to I held back some information. It's very important for us to know. The refund is given to the extent of input or input services only. Capital goods credit refund is not given under 89(4). That is why people who want capital goods credit want to pay the integrated tax first and take out the refund. Why they go under 96? Two reasons. I may have capital goods credit, which is also a sizable amount. If I pay the output tax by cash, I don't pay by cash, I debit the input tax ledger, the electronic credit ledger, I debit. I take it out as refund. The electronic credit ledger has three balances: input services, capital goods. When I go under 96, I can cash out everything, all the three. But when I go under bond, when I go under letter of undertaking, where I don't pay the output taxes by debiting, I don't pay the output taxes. What is the refund given to me? Inputs and input services only as per 89.4. Capital goods credit, no refund is given. That is the reason why exporters go under 96 rather than 89, because if the capital goods credit which may be accumulating, supposing I'm not able to utilize, I will get back. In my humble view, this is why 96 was being operated. So 89.4 says this. Fine, you are exporting goods without payment of any output taxes, services or goods you're exporting. So on the input side, I will give you refund. On the input services side, I will give you the refund of taxes. Very good. That full taxes I will refund. Everything was going well till they changed the formula suddenly. You know, this government and the bureaucracy, I'm sorry to say, they have become trigger happy. They are not giving the exporters their dues. I'm very deeply agonized by the fact that the government at its highest levels is promoting exports, while the bureaucrats are busy putting roadblocks. Everywhere you put roadblocks. In 2020, they changed the definition. You see, it's very funny. Turnover of zero-rated supply of goods. I told you it works like a 80 HHC formula. In this 80 HHC formula, export divided by total turnover of the business into input tax credit. So if my export turnover is substantial, I get a lot of refund. If my export turnover is less, I get less refund because it's a proportion. Everything was going well. Till on 23/3/2020, they made an amendment. They said when you calculate the numerator, it should be the turnover of exports or 1.5 times the domestic supplies, whichever is less. Now, what is this 1.5 times domestic supplies? Nobody has understood. How can turnover of zero-rated supply of goods and services refer to domestic supplies at all? If I don't have any domestic supplies in a quarter, I don't get a refund because the numerator becomes zero. If the numerator becomes zero, refund becomes zero. So 89.4C, which was amended with this funny definition which was there under the subclass 4C, led to a situation where several exporters are not getting their refund because domestic supply is not there. So immediately what they've done, at least they've filed a writ petition challenging this formula. What is this formula? 1.5 times the domestic supplies. See, if I have sizable domestic supplies, then I am not affected by this formula. But those who do mostly exports, they get affected by this formula. Unfortunately, 1894C has been challenged in the Karnataka High Court, and notices have been issued, and it is ripe for hearing anytime now. So I'm just hoping that my matter will be heard, and if it is heard and we get a good decision, we will be very, very happy, and I will report that to you. But 1894 causes this kind of problem. And please understand another thing. 1894, when you calculate the refund, you have to take it for that quarter, the tax period, okay, either month or quarter as the case may be. The credit taken during the month, the credit taken during the quarter, you can take refund. What about the balances? Accumulated balance, what happens? You are allowing me to take the credit during a month, credit availed during a month, credit availed during a quarter. I may have an opening balance and closing balance. What happens to it? Till now, people are thinking that this credit is lost. When I read through the section and rules, at the beginning of the session, I told you something. I told you at the beginning of the session that kindly split this into 3 categories: refund. Refund of output tax and input tax during a period, deemed exports, refund of unutilized input tax credit. Now, in my humble view, if you have any balances that are there in the electronic credit ledger because you're not able to claim it as a refund on exports, that is, you're not getting the full amount of refund on exports, you can go under 54(3) and apply for refund of unutilized input tax credit. There is no time period prescribed for it, especially for those who are 100% exporters. They're not able to claim the full refund because of this formula, or whatever be the reason they have credit accumulated. For them, they can go under 54(3) and say we have unutilized input tax credit because the principle is this. You have a 0 rating of goods or services. 0 rating means government has promised to refund. Promise is there. Actual refund will take its own sweet time to come. But there is a promise to refund. If that promise to refund is there, it can be enforced. You can't restrict my refund quantum through formulas. This is the message that I'm trying to get. If you're entitled to 100 rupees refund on exports, because of a formula, that 100 rupees cannot become 80 or 90. If it becomes 80 or 90, the balance can be claimed. Therefore, in my view, those who have accumulated credits on exports, and the formula in 1894 is not giving them the full refund because of some formula problem or the other, kindly calculate your tax amounts, see carefully where you're losing. And if you can, I'm saying it all depends on the facts of each case. Where in a case where you can actually claim a refund, is go ahead and claim the refund as an unutilized input tax credit, if the facts support you. We have come to 4:30. We will take a small break for about 5 minutes, as has been told by the organizers. Yes, ma'am. Yes.
Yes, sir. Sure. We'll take a 5 minutes break.
Just a 5-minute break and we will be back. Thank you.
Sure. Thank you.
Chai, as to say in Ernakulam, in Malayalam language.
Okay.
Correct? My Malayalam is correct?
Yes, sir. Cotton Jaya is correct.
Ah, very good. So I am learning Malayalam very well. Now we come back to the session. I have largely now told you 2 categories I have covered: export of goods and services outside of India export of goods and services to SEZ units, to SEZ developers. These two are, what are the options now available? As far as goods outside India are concerned, or services outside India is concerned, I can pay the tax, end product or end service tax, claim a refund. Or I can execute a bond and LUT, not pay the end product or end service tax, claim a refund of the input services and inputs. In the first option, where I pay the integrated tax and claim refund, what I do is I pay the integrated tax by debiting my electronic credit ledger. When I do that, and I cash it out, I can cash out input tax credit, I can cash out input services credit, I can cash out even capital goods credit. That is the advantage of Rule 96. But when I go under the second option of LUT and without payment of the end product or end service tax, 89(4) says you can take refund only of the input and input services credit, not the capital goods credit. So there is a clear discrimination between export of goods outside India through the 96 and export of goods through 89(4). That is impermissible in law. I told you the decision of the Zenith Spinners case, which said, as Gujarat High Court said, in the context of the Excise Act, you can't make a distinction between the two and force people to go only under bond. See, what the government is doing is this. They're forcing you to go under bond so that they will restrict the quantum of refund only to inputs and input services, and capital goods refund you will not get. This is very, very, very unfortunate. And they're saying if you export it outside India, yes, then you take capital goods refund. But for SEZs, no. Supplies to SEZ, supplies to SEZ units, no. Their capital goods you cannot get. How can you do this? This is against the SEZ Act itself. Because the moment, I'll give you an example, the moment I am supplying to an SEZ unit, the moment I know that I'm not going to get the capital goods input tax credit refund, which I can get on direct exports, because I'm doing both, I can adjust my pricing in such a way that I will be charging more to the SEZ units. Effectively, I'm passing on the tax to the SEZ unit. So I am hoodwinking the provisions of the SEZ Act indirectly. And if you notice carefully, Section 51 of the SEZ Act overrides the GST legislation. It overrides all your tax laws. And therefore, in a fit case, especially for supplies to SEZ, if you find that the pricing mechanism is not up to the mark, in my opinion, this discrimination between zero-rated supplies to SEZ and to exports outside India is violative of Article 14 and 19 of the Constitution, because there is no basis for this discrimination. Whatever refunds are possible for export outside India should also be given to supplies to SEZ and supplies to SEZ units, because they're treated as imports in the hand of SEZ. You should treat it as exports only. So that is the important distinction which I wanted to bring it out in this seminar, because the exports to SEZ and SEZ units are at a disadvantage when you look at exports outside India by a supplier. The supplier who does SEZ supplies has to go only under bond. He will not get the refund of the capital goods, which is probably accumulating in his electronic credit ledger, which he can cash out under 96 when he goes, where if he is exporting outside India. And that is the difference which I wanted to point out, and how 89.4 is ultra virus section 16, because neither section 16 nor section 54, if you look carefully at the wordings, talk of denial of credit on capital goods, refund on capital goods for exports. It doesn't say so. 96 allows you to take out that refund. But you debit the electronic credit ledger, take out the entire thing as a refund. Integrated tax. So these rules which have been formed, 89 especially, is ultra virus section 16 and section 54. 16 of the IGST Act and 54 of the CGST Act, and has to be actually read down or struck down or amended to include the capital goods credit component also. See, let me tell you this very clearly. In a value-added tax system means value added at the output minus value added at the input. And when I talk of input stage value added, it includes all types of credits, whether it is inputs, input services, or capital goods. There is no distinction between the three. If I've paid for it, I have to get set off, or I have to get refund when I export. Why are you not allowing proportionate credit refund on capital goods credit only? What is your problem in amending the formula in 89.4? Why? You don't want to give the credit to the exporters. Very unfortunate. How could you have a rule like this? Is he not exporting the goods? Should you not zero rate? What do you mean by zero rating? Zero rating means no tax on the input stages, whatever be the types of acquisitions, or whatever be the stage. So therefore, I think I've made myself abundantly clear on these two types of supplies, and I will leave the rest to the questions. Deemed export supplies, refund also I have touched upon and told you what are the types of refund which are available. Accumulated tax credit on inverted duty structure 89.5 I have dealt with and told you how there are two decisions which are at loggerheads with each other, and it's now pending the Supreme Court. I have myself filed a matter in Rajasthan High Court, and it has been stayed, and I argued the case for somebody else, and the stay has been given. And now, of course, all the matters will wait till the Supreme Court order comes. This is as far as inverted duty structure is concerned. As far as supplies to United Nations, I told you already at the beginning, there are certain notified agencies, for example, the embassies, the foreign embassies which are located in India, and the UN organizations, where the refund is not given to the supplier. The supplier has to pay the taxes. The refund is given to those agencies, and those agencies will have to apply within, initially it was 6 months, then it was expanded to 18 months of the end of the quarter when they receive these supplies. So the refund, as far as the supplier is concerned, your clients are normally the suppliers, so they have nothing to do in this. They have to pay the taxes, and the matter ends. And please understand, if there is any, as per Rule 95, if there is any international treaty which allows the refund, and the GST law is not in consonance with that international treaty, the rules itself says the international treaty will prevail over the GST laws. So that is very clear. Then we say, what about these amounts If you look at the refund mechanism, this is very important for us. We look at 54. There is a theory of unjust enrichment built into this expressly. What is this unjust enrichment? If I pass on the duty to the buyer, I cannot claim a refund. Only the buyer can claim a refund. Fine. So if you see the structure of the section 54, it says, leaving aside certain categories, when I prefer a refund claim, I must establish that I have not passed on the tax to a third person. How do I establish it? Through my accounts and through a CS certificate, especially if the amounts are more than 2 lakhs, I have to file a CS certificate. If it's less than 2 lakhs, self-declaration. But I have to establish I have not passed on the tax. If I cannot establish it, the refund goes to the straight away to the consumer welfare fund. Which fund, I don't know what that fund is. Since the days of 11B, I don't know what this consumer welfare fund is, how much amounts have been collected therein, how it has been utilized. I think a white paper has to be published on this consumer welfare fund over the last 20 years. What is happening with it? 91, you brought about this law. What is happening to this consumer welfare fund? How much money is being collected? How much has been spent on useful purposes? Or have you just kept the fund and transferred it into the consolidated fund? I don't know what is going on. But that is the law. Consumer welfare fund, it has to be credited. What are the cases where consumer welfare fund, it is not credited? Compulsory refund has to be given. What are the cases are listed in 54.8. So all of you should go and look into 54.8. What are the instances where credit is not given to the consumer welfare fund, but credit is, the amounts are paid back to the person? 1. Refund of tax paid on export of goods and services, or input services on exports. Either it was zero rated earlier, now it has become exports. That means to say, the theory of unjust enrichment will not apply to exports. When I'm refunding the tax for exporters, I'm not worried about unjust enrichment. As far as SEZ units are concerned, the Act says you are not going to pay the tax because you will do it always under LUT and BOT. Therefore, unjust enrichment, there's no question of you passing on the tax to SEZ units. Matter ends. As far as exports are concerned, they're not worried. You may pass on, you may not pass on. It's a different issue. Refund will be given to you. Similarly, on exports and inverted duty structures, 54, you will get the tax refunds. Unjust enrichment is not an issue for unutilized input tax credit refund under 54.3. 2 instances. Third, where you have given an invoice and a refund voucher. You're given an invoice, you're given a refund voucher. There also unjust enrichment doesn't apply because you refunded the tax to the other person. The refund of tax under section 77 or 19 in IGST, as the case may be. This is when you pay intra-state and then it becomes interstate, that kind of instances. Any other category which the government may specify. In all other cases, unjust enrichment will have to be proved that you have not done it. If you don't fall under 54.8, it will be compulsory for you to prove that you have not passed on the taxes to the other person. Now, what do you mean by passing on the taxes? The incidence of tax should not be passed on. Please understand, there is a presumption that you have passed on the taxes. 49.9 of the CGST Act, read with section 33 of the CGST Act, assumes that you have passed on the tax. 33 says you should indicate the tax amount in the invoice. Once you've indicated the tax amount in the invoice, 49.9 says, we presume you passed on the taxes. Rule 89 and the other rules go one step further. They say if you passed on the tax to the buyer, it is deemed it is passed on to the ultimate consumer. They have taken leaf out of the decision of the Supreme Court in Addison and Company's case, which went against the assessment, where the Supreme Court seems to suggest that unjust enrichment, if you pass it on to the buyer, then there is no way we can find out whether there's unrich, and you can never prove you have not, passed on the tax. We have to presume it is passed on to the ultimate consumer. Finished. So the theory of unjust enrichment will work against those who have passed on the tax to the buyer. They cannot claim a refund. It's the buyer only who can claim a refund. And he also has to prove he has not passed it on to the ultimate consumer. It's a presumption that he has to break and prove. Now, let me talk slightly different here. What it says, deeming fictions. In law, deeming fictions deem something to be something else. But legal presumptions, presumption is when you're presumed to have done something. At the first instance, we assume you have done this. But if you have proof, you can prove. Some legal presumptions are conclusive. You cannot lead any proof against it. And some legal presumptions, you can lead proof against it. So unjust enrichment is of the second category. If you can prove that you have not passed on the tax, you can claim the refund. There is no bar for you to claim the refund. That is the advantage of legal presumptions of the second type. Legal presumptions of the first type is conclusive. There also, in fact, there is a very interesting case. 112, 113, 114, all these of the Evidence Act, you go through. It's a very interesting case. I have to go into that case. It is a case where a child born out of wedlock, when two people are together, a child born is presumed to be belonging to them. Supposing you and your wife are staying together for so many years. Child is born. It is presumed to be out of the wedlock. It is conclusively presumed it's out of wedlock. That's what the Evidence Act says. When the Evidence Act was made, there was absolutely no, presumption at that time was conclusive because of the fact that there was no technological advancements at that point of time. Now, a peculiar case came to the Supreme Court where the husband alleged that even though this was a wedlock, they were staying together, the child was not his. And he had the DNA report to prove that the child was not his. But the opposite side lawyer said, sorry, it's a conclusive legal presumption. So you cannot lead any evidence. Which means, even though he is not the father, he would have lost the case. The Supreme Court made a departure in that case where they said, when Evidence Act was made and they treated certain things as conclusive evidence, conclusive presumptions, technology had not advanced. Now the technology has advanced and the truth is something else. A truth can be a defense to a conclusive presumption that is led and ruled in favor of the husband. A very interesting case for legal presumptions. So, even if it's a conclusive legal presumption, relying on the Supreme Court decision, you can probably say that truth is different. So as far as unjust enrichment law is concerned, fortunately, we don't have to go that far. Very fortunately, it says it is presumed you passed on. You can lead evidence to the contrary. That is the theory of unjust enrichment. So there is no problem in you leading evidence to that effect. So to that extent, the theory of enrichment can be got over. Now let us come to some other situations where section 54 will arise. Scenario number 1. I have paid some taxes on some assessments. And after the assessments are done, I go in appeal. I lose the first appeal. Now let us assume I go in to the second appeal. And in the second appeal, the tribunal says that yes, your case is accepted, appeal is allowed. Consequent to the allowing of the appeal, consequent to the appeal being allowed, I will be entitled for certain refunds. Now this refund, what the section 54(9) says, the refund should be made within 2 years from the date of the receipt of the order. So even if you get a favorable order from the appellate tribunal, favorable order from the commissioner of appeals, whatever it is, please file a refund claim. That's what it says. And that should be done within 2 years of receipt of the order in your favor. Scenario number 1. Scenario number 2, if you go for provisional assessments. Very few people go for provisional assessments, but because we are discussing refunds, I will discuss this. If you have opted for provisional assessment, then it's quite possible after assessment, some taxes are payable by you. So the officer will assess the goods and say this much of tax will be payable by you. I have paid more taxes. From that date, when the final assessment is done, within 2 years, I can prefer a refund claim for any excess amounts that I have paid. One interesting question that comes about always has been is that I have paid this 10% pre-deposit in first appeal, 30% pre-deposit before I go to the tribunal. Will this be hit by this 2 years clause or not? In other words, I'll put it clearly. I get an adverse assessment order. I go first appeals to commissioner appeals or JC appeals. I pay 10% as a pre-deposit under section 106, 107. Second appeal, when I go to the tribunal, I will pay another 20%, 30% in totally I pay as pre-deposit. The question is, if I win the case, should I give a refund of this 30% or not? Technically speaking, if you see the provision says, if you have a favorable order, you can apply for refund of taxes within 2 years from the receipt of the order of the tribunal. But you can take a legal plea saying this is not tax at all. This is only a pre-deposit. Where is the question of me preferring a refund? You are right, because Bombay High Court in Suvida's case says this. In the context of the earlier excise law, they say that. But I frankly advise all my clients and all the chartered accountants, don't get into these technicalities. If you receive an order of the tribunal or commissioner appeals or JC appeals, which is in your favor, and you have paid more taxes, you are entitled to a refund. Kindly prefer a refund application. After all, it's an application. Anyway, you have to write a letter. Rather, you file the application in the form, enclose the order of the. Normally, the appeals order will be uploaded. Sometimes they don't. you have given 2 years time, please file the refund claim. Be on the safer side, file the refund claim and take out the refund. This is what I tell most of the chartered accountants. You need not go into the question of whether it pre-deposit is tax or is not tax. Any amount paid under 54 is entitled for refund. Not just tax and interest. If you're found successful, if you're paid a portion of the penalty, you can take the refund. If you're paid any fees, any cess, you can take the refund. It's not in the interest payment, you can take a refund if you're paid any extra. So refund is not restricted only to tax and interest. It is also available for all payments which you have done. So let us be clear on that also. Now, international tourists who go abroad, what about them? You know that beyond the customs frontiers, you have the duty-free shops. The position of duty-free shops is very clear. In Atin Industries and in other cases, the high courts have clearly held duty-free shops supplying goods to outbound tourists. There is no tax on them because the supply doesn't take place in the territory of India. In the sense, it is meant for export. And therefore, it is a supply in the course of exports. And therefore, no tax will fall on them. So these duty-free shops and tourists who take away the are given a specific rule where they say refund will be given of the taxes that you have paid. That is to say, let us assume I am a supplier in Kerala, Ernakulam. I supply certain goods to a duty-free shop in Cochin airport. I will pay the taxes and supply. Now he will invoice a foreign tourist, a tourist who comes for only a short stay. After he collects the money in foreign exchange, he will file a statement with the officers saying that duty-free shops will specifically say that I have raised so-and-so invoice, I have paid so much tax on this goods, I should get a refund. So these people are also allowed a refund. Tourist would mean a person not normally resident in India, who enters India for a stay not more than 6 months for legitimate non-immigrant purposes. That is what section 15 of the IGST says. He comes on a tourist visa. He is not going to stay in India. He stays for not more than 6 months and leaves India after whatever tourism he has done. Such kind of people will be allowed. The people, the duty-free shops which supply to them will be allowed a refund. As far as refund is concerned, under section 77 and section 19, we need to discuss this carefully. These two sections are very important for us because this is going to be one of the most important sections going forth. We have a lot of cases also pending in the High Court. Now let us look at 77 carefully. What does it say? If you have paid integrated tax, subsequently it is held to be CGST plus SGST. What happens? You need not pay any interest. Section 19 of the IGST Act says, claim, we will give you a refund. Section 77 of the CGST Act says, you do not claim, you need not pay any interest. So what is the upshot of this? I have paid IGST. But I find it's actually CGST plus SGST. So what happens? Correct procedure is this. I should take a refund under the IGST Act. I should pay the CGST plus SGST. No interest is payable. This is the correct position in law. What happened in Kerala? The tax authority said, pay CGST plus SGST afresh. First you pay, then we will see. So when they went to the Kerala High Court gave a very nice interpretation. They said under Rule 92, they didn't quote the rule. Under Rule 92, you can adjust this. When I go for a refund under Rule 92, the officer can adjust any outstanding demand. So, ideally speaking, what the Kerala High Court said is, you can do it yourself. Why should he pay the tax and claim a refund from you? As an officer, you transfer it to SGST, CGST, and close the matter. Don't drag the person into more disputes. Very good order by the Kerala High Court. Very good order, very good, very practical order by the Kerala High Court. But in my opinion, that is not the procedure laid out in law. The law says only this: refund the integrated tax. No interest is payable. If you want CGST plus SGST, you must demand it in a proper demand notice under 73 or 74 proceedings. Adjudicate the matter. Then only you can adjust it at 92. See, the Kerala High Court decision is practically right, but is dangerous on one thing. The adjustment of tax under 92 can be done only for a demand which has crystallized, where no appeals are pending. It cannot be against an uncrystallized demand. 92 talks of an adjustment procedure only if my amounts are outstanding. And amounts are outstanding only after an assessment is done. Once an assessment is done and have not gone in appeal, then it becomes a confirmed demand. Those amounts can be adjusted under 92 against any refund. But where my appeals are pending and I have paid some 10% or 30%, whatever it is, they are not confirmed demands. Therefore, though while the Kerala High Court decision was very convenient for most of us, in an appropriate case, it will bite you. You have to be careful. You have to argue this point under Rule 92, specifically saying Rule 92 adjustment of, see, what will happen is, show cause notice they will issue and adjust that amount against a refund. That is not allowed. Rule 92 cannot be used for that purposes. Rule 92 can be used only when the demand has become crystallized, final. Only then you can use that. Otherwise, no. That is my humble view. Of course, some people can have a different view, but this is my view. Now, if you look at one facility that the government has done is under 54(6). Very good provision. When you export goods or when you export services, provisional refund of 90% of the tax is given to you, is supposed to be given to you in 7 days. Provided you don't have any prosecution pending against you in the last 5 years for a tax amount exceeding 2.5 crores. So that's a good, fairly good limit. Such people are given 90% provisional refund. And after that refund is given, the balance will be adjusted. Now, in what time frame they should do it? That is also indicated in 54. If I file a refund claim today, within 60 days, they are supposed to dispose it off. If they don't dispose it off within 60 days, interest will start ticking. Under 56, interest at 6% per annum is payable by the government. And if it is a refund arising out of the order of any appellate authority or court, 9% interest will have to be paid after the period of 60 days. So now what happened is, what the department used to do, you get a refund claim, immediately they'll send it back to you saying this is a 59th day, they will tell you this is the deficiencies. File a fresh refund claim. By the time you correct your refund claim and then file it, it will be beyond 60 days. So there is a section of the GST officers were saying this refund is you have if it goes beyond the two years period, it is, they will say it's time barred. We are sorry, your initial claim was within 2 years, but when we returned it to you, your subsequent refund is beyond 2 years. So luckily they amended Rule 90 recently and said no, not like that. Even when I give this amended thing, the time bar will not apply. But the 60 days time limit will start applying only from the time I give the revised refund claim. Please keep this in mind. There are some documents which are not there. Revised refund claim is given, and within 60 days of that, they are supposed to dispose of my refund. In other words, dispose of means either they should reject it or they should give you the refund. If it goes beyond 60 days, interest will be payable by the department to you. And you have several decisions of the Supreme Court in the earlier regime, Ranbaxy's case, where they said specifically, Supreme Court has said, interest will tick from the date of completion of 60 days from the date of submission of your application. That's it. Of course, if it is rejected by the officers and it goes in appeal, then the interest clauses will not apply. Then it's a disputed refund, it goes in appeal and then it gets allowed, and then you have to file a refund claim once you get a favorable order. That is how the law says. That is as far as provisional refunds and refunds are concerned, where the application now, they have at least done one good thing, is that they've allowed you to file a revised refund claim, and that will not be considered as time barred if the original refund claim is within the time limits. Now, there is one provision in law which we need to now discuss. Rule 93, which I've also challenged in the Karnataka High Court. What does this Rule 93 say? It's a very funny rule. If you look into this rule and see, Rule 93 applies in certain cases. Look at it carefully. Where any amount claimed as refund is rejected under Rule 92, either fully or partly, the amount debited to the extent of rejection shall be recredited. Very good. An explanation is fixed. For the purposes of this rule, a refund shall be deemed to be rejected if the appeal is finally rejected, or if the claimant gives an undertaking in writing to the proper office, he shall not file an appeal. This is very unfortunate. What is it saying? Let us assume I prefer a refund claim, 100 rupees. Now they accept my refund claim for 60 rupees, grant me 60 rupees, reject 40 rupees. Once the claim is rejected, I should get a recredit of that 40 rupees. Where he says, no. You have debited 100, you claimed a refund of 100 rupees. You debited 100 rupees in your electronic credit ledger. I gave you 60 rupees refund. Balance 40 rupees, you cannot get the refund. I will also not allow you the recredit unless you give up your right of appeal, or unless it is decided by the Supreme Court finally. which is a period of 5 years, 10 years, as the case may be. So you would have reversed 100 rupees, claimed 100 rupees as your refund. The authority will give you only 60 rupees. 40 rupees he rejects. But 40 rupees you cannot claim as a recredit. Because rejection would mean only when the appeal is disposed of. If you go in appeal or you give up the right of appeal, then I will give you refund, he says. You will take the recredit. That means they are saying, I will not give you the recredit unless you accept to forego your right of appeal. So I have challenged this particular rule, explanation with the Karnataka High Court saying this explanation to Rule 93(2) is ultra vires Section 54, Section 16, where and Section 107 and 112, where you're forcing me to give up my right of appeal. This is a very unfortunate rule which is there. I do not know if you people are affected by it, but if you are affected by it, please keep in mind this. Now we come to another situation, which I will discuss. One or two situations I will discuss and then throw open the floor for questions, because I would like to have the question answer session in detail. Let us assume that there is a classification dispute. Please understand, in any disputes under the Customs Act, a refund cannot be filed independently. If there is a classification dispute under the Customs Act and you don't challenge the bill of entry, later on you prefer a refund claim saying I should have classified in that manner. ITC's case, the 3-member bench of the Supreme Court says, we are sorry, you should have challenged that bill of entry. If you have not challenged the original bill of entry, you cannot now get a refund. So classification matters, you should always challenge the assessments. Refund is a consequence of it. Fortunately, in our GST law, we don't have this concept of bill of entry being an assessment order. So this law may not fully apply. But where it will apply is, if there are any assessment orders passed and you don't challenge it, tomorrow you can't take the benefit of some other assessment order which is in the assessee's favor. Because in your case, you have already lost and you're not challenged. So my advice to all clients as well as chartered accountants is, because the matter is small, don't leave it. Especially if it's a classification matter, HSN matters, don't leave it. Today it may be a small amount of tax, but tomorrow, after a year, 2, when the tax structure changes, substantial tax may be saved because you are putting it under some other heading where it belongs to and you have not challenged it. So please try to take the benefit of those challenges also. Don't leave any order because the tax amount is very less. There are 2 schemes which I told you I will deal with. What is called ROSCTL scheme, that is rebate of state and central taxes embedded. This scheme has been announced for the textile sector, made up garments, exports, in addition to the duty drawback. See, there is one problem with the refund structure in this government has actually done a very good thing. Taxes will take care of one portion of the pricing. But there are several embedded taxes which are never taken care of. For example, taxes are paid on electricity. That tax you never get a rebate. You never get a refund. Taxes will be paid on several other inputs, pesticides, fertilizers. etc., where you may not get the refund at all when you export. So this scheme for textile sector has been announced that the state and central embedded taxes will be refunded in addition to the duty drawback. This is one scheme. The other scheme which the government is talking about as a replacement to the MEIS scheme, that is manufactured and exported from India, or SEIS, served from service exports from India scheme. They are saying remission of duties and taxes on exported products, that is called the RODTEP. This scheme was to come in effect from 1st January 2021. Now we are in 23/7/2021 and they're still haggling about the rates. But if this scheme really hits off, it will be a wonderful scheme for the purposes of refund of not just the GST amounts. The RODTEP scheme will refund all embedded taxes on exports. And in fact, I believe this PLI scheme, that is the production linked scheme, incentive scheme, which is a huge hit in India and is actually making people transfer their factories from our neighboring countries to India, China to India. The PLI scheme, read with the RODTEP scheme, if the government implements this properly, I can tell you, you will have in the next 10 years a major shift of manufacturing industries from outside to India, provided we can give them huge tracts of land at reasonable prices, uninterrupted power, uninterrupted water. If these three we can give, we can match any other country. Just giving only refund of taxes is also important. You have to also match it with these things. So these are some of the thoughts on refunds which I thought I will share with you. I would like to take the questions, and I would like to know how this, this chat box, if it is there, what are all the questions which I can take?
So some 4-5 questions have come in the chat box, sir.
That's all, very bad. Why?
No, I think it's more than that. Yeah, 8 questions.
Huh?
8 questions. 8 questions.
8 questions is good for 20-25 minutes. No problem.
Yeah.
Then it will keep coming.
So,
yes.
You want me to read them out for you, sir?
Oh, no, I can see them. That is this. First is that whether MEIS received. That is the one. Huh?
No, how to proceed.
I'm sorry.
I think, yeah. How to proceed further when the refund application for financial year 2018-19 is rejected, since the refund application is filed after 2 years from the relevant date. It's applied in June 2021.
Where is that?
It's come in the Q&A chat box, sir. The first question. That's.
I can see only 3 questions here, my dear. Chat box is there.
No, there is one more box. A Q&A box is there, sir. To the right, there are 3 boxes.
Where is
So
the Q&A? Yes, Q&A. Yeah. Sorry. What does this give? Q&A. Let me see. Q&A. How to proceed? First question.
Yes, that's the first question, sir.
I'm not able to, for some reason, I'm not able to see it properly.
No worries, sir. I'll read it out for you.
I think, yes, better. I don't know how, probably I don't know how to do it.
No. How to proceed further when the refund application for the financial year 2018-19 is rejected, since the refund application is filed after 2 years from the relevant date, applied in June 2021.
Now, first you check out what is the refund for. If it is unutilized tax credit, as I've told you in this session, you can go ahead for the refund irrespective of the tax limitation of 2 years. There is no problem. 54(3), first clause, if it is exports of services outside India, and SEZ, you can claim the unutilized tax credit without any reference to time limits. But if it is not that refund, time limits under 54 becomes sacrosanct. We are fighting lot of cases on this time limits. Courts nowadays, after the Mafatlal Industries decision, courts are of the view that all refund, the time limit under section 54 is mandatory. It is to be followed, and there is no relaxation in the time limit can be given. This is the court's view of 11B, as well as the notifications which are issued under 11B and 27. There are two things which are accepted. Please keep in mind, I told you refund of unutilized input tax credit on zero rated supplies, where no time limit seems to have been prescribed by the law. That is one. Second is, what you have paid is not tax at all. You have paid an amount believing it is tax that is not payable. Tomorrow, let us say you go to the High Court, get it struck down. It becomes an unconstitutional levy. In those cases, the time limits under section 54 will not apply. These are the two cases. All other cases, 54 will apply.
So Soman sir is wishing you good afternoon, good evening. And
yes, good evening. He's one person whom I love interact, but his questions are very tough. You can't answer across the.
His question one is, exporter of service gets GST registration upon crossing the threshold limit during the financial year. Applies for LUT, but at the time gets LUT continued export services by raising non-GST invoices. Whether export before getting LUT is taxable. If yes, what would be the transition provision in similar situations?
It's wonderful. This is what I told you. You see, in my view, exports cannot be taxed. Whether it is before registration, after registration, whether you're a registered person, unregistered person. You may say that registered person only gets the benefit under this GST regime. But that is not so. You can't tax exports. You may deny me certain benefits. You may say, I will not give you input tax credit refund because you're not registered. You may say that I will not give you any other benefit to an unregistered person, but you can't tax me. This is what I told in the beginning of the session. By nature, if the consumption is outside India, there is no tax on the end product or end service. And that tax cannot be recovered from you because there is no tax on consumption outside India. It may not be exports because you are not realized the foreign exchange or whatever it is. But tax cannot follow exports. That I'm very clear. It is the same position in service tax. The same position continues in GST. Tax cannot follow exports, even if it is not exports as defined under the GST Act.
So the next question is from Roy sir. One of the client is exporting vegetables. The client is paying GST on freight and packing material for exporting the goods. All GST returns have been filed on time. Can we claim refund of the unutilized input tax credit irrespective of the 2-year time limit specified in section 54?
That is what I have told, because the unutilized input tax credit, I am not able to see a time limit.
But one problem, sir, I think.
Yes, sir, Roy Varghese ji.
The party has filed online, they have filed the application, but subsequently, department rejected it.
Go in appeal, my dear, go in appeal.
But the problem, subsequent period is also getting delayed, sir, because the system is not allowing to file the subsequently.
Why it is not allowing you to file?
Because unless we waive our claim for the previous period, subsequent period is not.
Please go to the please. This is what I was telling you. This rule 92 nonsense which is there, 93. Please challenge it in your high courts.
Yes, sir. Yes.
Rule 93, the explanation has become a nuisance for exporters. You give up the claim for appeal, then only we'll restore input tax. That is not correct.
Yes, sir.
This is a good chance because you go to high court.
Yes, sir.
Challenge the provisions. You have some very good people in Kerala High Court who will just easily understand what you are telling.
Yes, sir.
Please go to the High Court.
Thanks, sir. Thanks.
So Soman sir's second question is such: what would be the impact of the Honorable Supreme Court decision and recent Civic circular on time limit for filing refund application?
See, when I was talking this COVID limitation order, I had already mentioned the biggest problem for the industry is going to be whether the time limits under the GST legislation are covered by the Supreme Court order. And had also mentioned that the Supreme Court order does not seem to cover it. But I had also told one more thing. If I cannot file my appeals, how will I file my returns? You are saying appeals or hearings, which are one-off instances. Every day you don't file an appeal. Every day you don't go for any hearing. That itself, the COVID limitation order extends. Because you are realizing that people are not attending their offices, so they will not be able to file the appeals. If they cannot attend the offices for filing of appeals, why not for returns? I don't see any reason why this should not be extended to returns. In fact, the CBIC circular should be immediately challenged. Reason being, if I am an employee, I cannot attend as you take your Kerala, for example. Are you allowed to go to offices in lockdown period? Fine. So in lockdown period, you will not be able to file appeal. That is being condoned. How will you file the returns? I cannot go to office. I can't go to office for every purpose, including filing of returns. Why only appeal? So you cannot say that Supreme Court has done only for these two categories. I'm sorry, for other categories, you follow my CGST Act. That is wrong. It is completely wrong. See, when Supreme Court was approached for appeals and applications and suits, yes. But statutory compliance also requires employees to be present. So in the lockdown period, you can't expect them to comply with it. And you may or may not extend the time period. It depends on your whims and fancies. It depends on your whims and fancies. I like your face, I will extend the time limit. I don't like your face, I will not extend the time limit. This is the whims and fancies on which law is running today. So I don't think, I have a feeling that the CBSE circular should be challenged. And for all practical purposes, in my view, you must extend the time period for filing not only this, even refund applications. So even the 2 year which is there should be extended during the lockdown period. You can't expect people to file the refund claims when the employees are not attending the office. Yes, ma'am.
So the next question is on exports again. In case of export of fish or fish products which are exempted from GST, the exporter cannot go for the payment of IGST since the rate of tax is nil to get refund of IGST of capital goods. Is this correct?
Yes. So what the exporter should do? See, as per section 16, even if the goods are exempted from tax, they are still zero rated goods. So he can claim tax on inputs and input services under 89(4), but he will not be able to get the capital goods credit. So he has to file a writ petition challenging 89(4) as being ultra virus section 16 of the IGST Act and section 54 of the CGST Act. That is the only way he will get relief. Going in appeal, first appeal, second appeal, no use. You are not going to get your refund of capital goods credit. You have to go only to the High Court in such cases. And if the amounts are huge, please go to the High Court.
Ramangati sir, I understand that you have been unmuted so that you can ask a question, sir. Please go ahead, sir.
Yes, sir.
Yes, good evening. Please, sir.
My first question is already answered. That is, it is covered by Soman also. That is on the recent circular, 20th circular. Right now, my question was whether it will apply to delayed refund application filing. That you have covered that it has to be challenged.
Yes.
It has to be challenged. That answer I got. Then second one is not related to the present subject what we have discussed. Can I ask that question, sir?
So, Mr. Ramankuti, you know my relationship with the Ernakulam branch or with any question you can ask, whether it's related to refund, not related to refund.
Query number 2 is on the definition of business.
Yeah.
I'll read out an last item of the definition. Any activity or transaction undertaken by
Yes, sir. Please continue.
Any activity or transaction undertaken by the central government, state government, or any local authority in which they are engaged as public authorities, that is coming within the definition of business. My point is that hitherto, probably after the 2006 amendment in service tax regime, where any service has been introduced, subsequent to that, the argument that we used to take, it is within the sovereign power of the government. Assume I am paying a fee under a particular statute. I am paying a fee under a statute. We used to argue that it is a statutory payment. It is within the sovereign powers of the government. It is not a consideration. Now, because of this insertion, can I utilize that credit? And I am referring to one more Supreme Court decision that can you read, Deepa? That last part I cannot take it from this one. One Supreme Court decision I am giving. Last.
The last.
Yeah.
The last part. Please clarify how this can be. Before that, sir.
Yeah.
Regarding the SCN.
No. It is not SCN. One Supreme Court decision I am giving. Whether the Supreme Court decision will cover what the Supreme Court decision conveys is fees paid under a statute is not a consideration. That decision I am unable to take it from here. 1 minute. 8 minute I will give. It is a Apex Court decision in Agricultural Marketing Committee versus Rajaram Jute and Oil Mills Association. Whether it will apply notwithstanding the definition in 217 of the CGST Act.
Yeah, I've understood your question.
Yes, sir.
See, there is a fundamental, understanding. There's a difference between sovereign powers, statutory powers. Now, 2006, they issued a circular saying if the government does anything in exercise of its sovereign or statutory functions, it is not a service for consideration and therefore no tax will come. This is what the government issued in 2006, which they later withdrew in 2016 because they got frightened about the cases which were being filed. In fact, I remember it's a reported decision, KIDB matter, I argued this case at length. And the tribunal gave me a relief of 1,500 crores.
I read that decision, sir.
Yes. On the ground that it is a sovereign function. Now, there is a difference between what is sovereign and what is statutory. Sovereign function means what belongs to the state exclusively and no other person can do it. For example, defense. Only the state can do. For example, land acquisition. That is where I fought the KIDB case, where I said KIDB is an agent of the state for land acquisition. So it is doing a sovereign function. Sovereign functions are inalienable functions of the government. What only the government can do. And therefore, those functions cannot be taxed. Please be very clear. Sovereign functions cannot be subjected to tax at all because that is something which the government does. What can be taxed? Even if your 2(17), if you see, does not cover sovereign functions.
Okay.
1. 2. Statutory functions. Let us look at it. Now, statutory function can be split into 2 types. Statutory functions which by nature, by definition, if you look at the Bombay High Court decision in MIDC's case, that is Maharashtra Industrial Development Corporation case, what the Bombay High Court said was this. MIDC does a function under the Act. It's a statutory function. May or may not be sovereign, but it's a statutory function. A statute is passed by the legislature. A corporation is given certain functions to do, develop industries in the state. Like your KSSIDC, whatever is there in your Kerala state, to develop the state, industries in the state. That is a statutory function. This statutory function also is prescribed if you look at MIDC's case, is done as a duty. It is not a consideration for a service for consideration. So in my humble view, statutory duties that are done by public, by the state or central government cannot be taxed.
For which I am making a payment of fee.
You can pay anything. It is not a fees. Please understand, it is not fees. It is simply a statutory impost.
Two simple example I will give, sir. For police protection, either the banks or NBFC, when they are carrying the cash, they take police protection.
Yeah, that is a sovereign function itself.
They have to make payment to the district police office.
It's a sovereign function itself, because prevention of robbery, in my opinion, is a crime that has to be protected by the state, not by me. So the police functions of, in my view, I'm not saying my view is correct or wrong. My view is that it is a sovereign function, police powers. It cannot be subjected to tax payments.
That's all.
Let me finish.
Yeah.
Let me finish. There is a difference between tax and a fee. Fee is collected for services done. Tax is not collected for any services. Both are compulsory extractions, but fee means I require a service to be done. So please understand, this business includes any activity or transaction undertaken by the central government, state government, or local authority. It doesn't stop there. It says in which they are engaged as public authorities. What do you mean by that? Public authority means that they are having interface with the public. And you are supplying something to them. What is that you are supplying? A service or goods? Only in such cases, it is deemed to be business. If you look at the UK VAT, for example, UK VAT provisions are substantially different from us in this respect. Governmental functions which have no competition cannot be brought to tax under the UK VAT. The concept of competition is, in my opinion, that is what has been actually built into this. When you say as engaged as public authorities, that means you are rendering some services to the public, or you are supplying certain goods to the public. Then you can be brought to tax in the on the ground that it is the business includes these transactions. But if you are doing it as a monopoly, if you're doing it as a statutory duty, if you're doing it as a, let us say, sovereign function, these cannot be brought to tax. Now, as far as license fees are concerned, there is a difference of opinion. License, if you see, the earlier days, the license was, if it was regulatory in nature, it becomes a tax. It is not a fee, and therefore you cannot have a tax on tax. But if you look at Article 110, money bills, which they talk of, it excludes bills for any permission granted or any licenses granted. It will not be a money bill. So let me put it this way. Sovereign functions, no tax. Statutory functions, no tax. Wherever the government renders a service or supplies goods as public authorities, there maybe you can bring in a tax, but if there is an exemption, it goes out of the tax net. In my opinion, the UK VAT principles should be imported here, where they should make it taxable only for people who are in competition. If there is no distortion of competition, tax should not come at all. This is my view to your question. The answer to your question, Mr. Ramankutti. Therefore, there could be several fees collected. If the fees is for services rendered, probably you can bring it to tax. But if it is a regulatory tax collection, it cannot be brought to tax because it will become a tax on tax.
That's all, sir. Thank you.
So now we'll continue. In situations like cancellation of service contracts after making advance payments, Section 34 does not provide for issue of credit note by the supplier. There is no provision similar to Rule 6.3 in the erstwhile service tax rules. In that case, how can we claim the refund of tax paid on advance received?
Advance received, if you have remitted the tax, there is something called a refund voucher. Issue the refund voucher, you don't need to, refund voucher and claim the refund. The matter, I think, would end. But I'm sure if I've read that section properly, it says you should not have issued an invoice. So effectively, it will mean you can take a refund if that man has reversed the credit. If he has not reversed the credit, you cannot take a refund.
Next question is, what will be the impact of the Supreme Court order on time limits and the reset? Same question has been repeated, so we just move forward there. Is a time limit of 2 years applicable to refund application of wrongly paid taxes? For instance, CGST and SGST paid instead of IGST, and correct IGST paid and refund of C&L. Please advise.
No. See, you can, the statute says the refund has to be given. Section 77 simply says refund has to be given. That's all. So there is no statutory. See, you can say one view can be that relevant date will start from the date of payment. That is one interpretation that can be given to build in this 2-year theory. But in my opinion, Section 77 and Section 19 of the IGST do not talk of any time limit for the refund. Simply says refund has to be granted. So therefore, a procedural time limit under 54, in my humble view, cannot be bought in to restrict refunds under 19 or 76.
So next question is from a chartered accountant who's saying,
all are chartered accountants only, no?
Yeah. I am working in a textile trading company. Our total input tax credit at any point exceeds the total output tax liability, and hence we are required to remit tax only under RCM every month. As a result, the unutilized ITC keeps on accumulated in the credit ledger, and now the balance has exceeded rupees 1 crore. Do we have an option to claim refund? Please note, we do not have inverted duty structure.
Then why is it accumulating? Is it because of, you have to look at how much of it is, are you 100% exports? If you're 100% exports, then you can claim the entire credit, unutilized tax credit. Otherwise, one has to, you have to hire a chartered accountant to, you yourself being a CA, please go in and study the textile business and see why the credit is accumulating. If the credit is accumulating because of exports, you can claim a refund. Otherwise, since you have said that it is not inverted tax structure, otherwise you have to live with that accumulation.
The next
but please make please make a careful study, because textiles, I'm told some sectors are having inverted tax duty structure. Please make a clear study.
Refund of unutilized input tax credit is being rejected on the foreground that the supplier has not filed GSTR 3B, despite the input tax being reflected in GSTR 2A or 2B of the recipient. Is this not violation of Circular 135, which states that refund shall be sanctioned in respect of input tax credit reflected in GSTR 2A? Such rejection can be sanctioned. Officers
you see, this 2A fellow keeps on changing. At no point of time you can see it properly. Today I see it in one form, tomorrow it's in some other form. So the officer, when he sees it, he will see it after several days when you have filed it. There will be a difference. But in my view, just because it is not reflected in 3B doesn't mean it can, you should lose the substantial right of refund. Please take it in appeal. You must surely have other evidences. Show those evidences and take it in appeal.
Yes, then refund of unutilized input tax credit on account of exports is being restricted to FOB value of the goods based on Circular 37. Kindly share your views. Circular 37 says shipping bill value. Nowhere it mentions FOB value.
See, if you are invoice value is different, you have to see why it is different. Normally, the insurance and freight values are not included for the purposes of any refund. Now we have to look in and see what is, in my view, we have to look in and see what is the transaction value under section 15, valuation. So you have, in which case, you have to either appeal to the first appeal or second appeal saying that GST refunds must be based on my transaction value and not on the FOB value. It's a matter of interpretation, and we have to wait and see which way the matter will go.
So, refund claim from ITC ledger is rejected and debited in electronic credit ledger. How to take credit for the same in export cases?
Refund is rejected, and then once your entire refund is rejected, they recredit the amounts. That payment 03 some form is given, and they recredit the amounts into the electronic credit ledger. Unless you are faced with this Rule 93 explanation, which I was discussing in my speech. If that is the case, then you have to go only to High Court. You have to challenge the explanation to Rule 93. Otherwise, just look in and see if they've forgotten to give you the payment 3 form, please file that and ask them to give the refund. File a letter first for the grant of refund before you go to High Court.
I think Sri Kumar sir had earlier asked a question about the wrong payment interchange between CGST, SGST and IGST. So in continuation, he has written payment of GST and a wrong head credited payment made in DRC 03. The GST department is refusing to refund the excess tax paid.
No, they are supposed to give it. They have no other option but to give it. See, these are all clerical errors which can happen to anyone. So if they refuse to give you the credit or the refund, write 1 or 2 decent letters to them. If they are not still acceding to that request, you have no choice but to go to the High Court, sir. And your High Courts are quick. They will grant you the refund.
So the next question is not related to refund. Where services are provided to a foreign customer and the place of supplies in India, as a service provider is an intermediary, which tax should be charged, IGST or CGST, SGST of the state in which the supply?
See, this intermediary business, is already challenged. Intermediaries are under an unfortunate situation because as per the section 13 of the IGST Act, 13(8) of the IGST Act, and Rule 9 of the place of supply rules under the service tax rules, the place of supply is deemed to be in India. So intermediaries are forced to, as per the department, pay a tax. This was challenged in the Bombay High Court recently, and the judges have passed 2 different opinions. So it has gone to the 3rd judge for difference of opinion. As far as service tax regime is concerned, I have filed a writ petition in Karnataka High Court and got a stay on the matter as far as intermediaries are concerned. So that matter has to be heard at length in due course. I've got the stay only about a couple of months back.
So the last question till now is a builder gets into a contract with a customer, receives money and pays taxes. Later on, the client wants to cancel the contract. Can the GST component paid in respect of his contract be refunded?
If you're not done any service, yes. You're not raised any invoice, you're not done any service, yes, it can be done. But if you've already rendered, under the contract, the services, refund will be difficult unless you challenge the very levy. Let me openly tell you, builders and developers, if you are rendering construction services or works contract services, as the government feels, you can apply for a refund only if you challenge the notifications that have been issued. Otherwise, you should be able to prove that you entered into a contract with the buyer and you rendered absolutely no services to him, and therefore now you're refunding the amounts to him, and the tax also has to be refunded. In which case you should have issued an invoice. You have to follow through the refund voucher methodology. That then you take it.
So one more question has come. Whether MEIS received to be considered as exempt income for proportionate reduction in ITC?
No, in my view, this MEIS receipts, the SEIS receipts, these are not, I'm sorry to say, these are all export incentives. These are not any, they are not, they should not be considered as exempt supply because it is not supply in the first place. So you can take credit completely for it. There's no need for reversal.
So I think, yeah, again, one more question has come. Sir, on one case, there was excess payment of output tax through March 2019 3B filed on April 15th, 2019. Refund application filed on 5th April 2021. Deficiency memo issued by department. It was unattended due to COVID and lockdown. Now, what is the remedy available? If filed a new application, it will be affected by period of limitation.
No, that rule 90, please understand. Rule 90 now has been amended to say that you can file an amended application. Please file an amended application. Please do it. Because of COVID, you're not able. It's a perfectly valid excuse. Forgo the interest. That's all. You get the refund.
Yes, sir. I think so far that's all from our side.
Yes.
Would you like to give any closing remarks, sir?
None at all. No. I leave it to you.
So thank you so much, sir. Thank you so much for joining us this afternoon. And what a structured way to explain GST and various refunds, not just related to exports. Whenever you hear GST refunds, it's mainly related to exports. And yes, the queries also shows that. But otherwise, you have structured it so beautifully that, I think everybody who attended today's session is very clear on what refunds are there in GST. Thank you so much for joining us, and we would love to host you someday in Ernakulam once all this COVID is over, and yes, accompany Guru Ayur for your darshan, sir. And to all the participants, thank you so much for joining us in such huge numbers, asking questions and making this session so lively. Please do join us tomorrow again at 10 a.m. The session will be handled by Advocate J.K. Mittal from New Delhi, and he is going to talk to us on how to face department investigations, fake invoices, demand show cause notices, adjudication appeal procedures, etc. So hoping to see all of you tomorrow. Thank you so much once again for joining us.
Thank you, ma'am. Thank you.
Thank you, sir. Thank you very much.
Thank you, sir.